Germany has undertaken a significant legal commitment to achieve climate neutrality by 2045. This ambitious goal necessitates a complete restructuring of the country's energy landscape. Achieving this will require substantial financial resources, with projections ranging from 1.1 trillion euros to as much as 5 trillion euros. Given the magnitude of these challenges, the government alone cannot bear the financial burden. Therefore, capital from institutional investors and the asset class of infrastructure will be crucial for financing Germany's future. In our new publication, we delve into the current opportunities and challenges for these asset classes. We examine the general environment for infrastructure investments with a focus on the German market, discussing location factors and investment obstacles. Our study is based on the data from 109 German institutional investors and 13 interviews with industry experts. This video provides a brief insight into some of the key findings. Infrastructure equity and infrastructure debt are integral parts of the portfolios of German institutional investors. Infrastructure equity, in particular, is the second most favored alternative asset class, only behind real estate equity. Our data reveals that infrastructure equity and infrastructure debt have significantly outperformed other alternative asset classes in meeting investors' expectations over the past 12 months, despite a challenging market environment. The BAI Alternative Investment Sentiment Barometer also indicates a significantly more positive outlook for infrastructure equity and debt compared to other alternative asset classes. A clear majority of institutional investors plan to increase their allocations in infrastructure equity and debt, highlighting the growing strategic importance of infrastructure in their portfolios. Our research also identifies obstacles like macroeconomic risk and high interest rates, which have led to liquidity constraints and a downturn in infrastructure transactions. Nevertheless, forecasts suggest an improving liquidity situation with expected interest rate cuts, revitalizing infrastructure deals. Despite short-term challenges, megatrends such as digitalization and the energy transition are expected to drive long-term development. Renewable energy is experiencing significant growth, positively impacting the entire infrastructure asset class. Our survey data shows that most LPs primarily invest in infrastructure projects outside of Germany in the moment. However, expert interviews also reveal attractive investment opportunities within Germany amid improving conditions. For this reason, we examine key location factors for infrastructure investments, and in our interviews we discuss how they are present in Germany. The structure of the German energy market was named to influence the risk-return profile compared to other markets. Also, skepticism about private capital role in financing the energy transition, along with concerns about unclear ESG regulations and the need for regulatory improvements, are discussed as potential threats. We also explicitly analyze the challenges for infrastructure investments in Germany. In particular, we discuss infrastructure quotas for pension systems as a possible concrete measure to improve investment conditions. In conclusion, policymakers must address existing shortcomings and recognize the critical role of private capital in driving digital and ecological transformation. This requires a clear and consistent regulatory framework. Despite short-term challenges, the long-term outlook for infrastructure remains positive, driven by underlying megatrends. Thank you very much for watching. For a deeper dive into our findings, download our full publication.